Hello, everybody. Thank you for dropping by. My name is Jun Du. I'm a professor of economics based in Aston University. I'm leading a research center called Lloyd's Banking Group Center for Business Prosperity, and I'm leading on research on trade and productivity. And today it's my great pleasure to talk to you about our recent research and insights on UK companies' trade diversion in a dynamic, globalized world. Just a bit of brief about myself. I'm trained as an economist with a particular interest on firm productivity and growth. The recent research focus of mine and my team at Aston has been around firm trade. What I'm going to talk to you about today is mostly based on our recent research, some listed on the slides that you might see now, which you can find a copy on our website at the end of the presentation. Please check them out. What's the topic today? Now, I'd like to share with you some of the facts, thought leadership, and research findings available on some of the recent UK's trade patterns. In particular, the emerging trend of the UK firms' trade diversion from EU markets to elsewhere following the Brexit referendum. I would then bring you some of the recent figures on how UK's trade has fared the storm of COVID, reflecting on where trade and more broadly globalization may travel and why. I'll conclude by highlighting some of the opportunities and challenges faced by UK traders looking beyond COVID and Brexit. Now I'm going to tell you about the first very detailed study provide evidence that UK firms were defying gravity that I will explain in a minute and switching their export destinations pre-COVID period. You may have seen some coverage of this research in The Guardian and The Times. To start with, the normal pattern in global trade is that countries trade the most with the countries that are closest to them, especially the big ones that are close to them. In terms of physics, this is called gravity theory of trade. Close objects have much stronger gravitational pull than objects farther away. By this token, it's natural that EU is by far the largest trade partner of the UK, which represents 47% of the total trade and nearly 50% of the total exports in the latest figures in 2018. Over a rather long period since 2016 June, there was a sense of UK firms getting lost or even paralyzed. There are a few snapshots on the right-hand side of the slides from the large and frequent coverage over time on the Brexit uncertainty in the media. Nobody quite knew what might happen, and nobody seemed to know what should happen. Uncertainty were the only certain fact. Therefore, the question here we're asking is the following. Has the trade policy or in general economic policy uncertainty disrupted firms from trading as usual? And more specifically, have the UK firms started to export against gravity following the 2016 Brexit referendum? This is an interesting and very important question. We conducted some research based on the very granular level of data, the HMRC UK trade transaction level data, to examine how firms reacted towards Brexit uncertainty. The period we looked at covers the whole referendum announcement period since 2015 through the referendum period in June 2016 up to the triggering of Article 50 notice of withdrawal from EU in March 2017. And we also tested our findings towards the end of 2018. Before I tell you our specific findings from causal analysis, I'd like to highlight some patterns revealed in the raw data. The figure that you see on the left-hand side compares the average yearly growth in the exports to EU to exports to non-EU destinations in each quarter between 2012 to 2017. What is shown quite clearly is that there has been a parallel downward trend in the growth of both intra and extra-EU exports in export values over time. However, after a sharp growth in both flows in the first quarter of 2016 compared to the 1 year earlier figure, the two trade flows have followed very divergent paths from the third quarter of 2016 onwards. After the Brexit referendum decision in June 2016. Now, growth to EU and non-EU over the same period, depicted on the right-hand side, shows this as well. We can clearly observe that up to the second quarter of 2016, intra-EU quarterly exports were decreasing less rapidly than extra-EU flows. Hence, the positive slope of the curve up to this point. However, the trend was sharply reversed after the Brexit referendum, with extra-EU exports kept on growing while intra-EU flows decreased significantly. World tariff levels vary markedly by type of product. Under a no-deal scenario, the EU and UK would revert to WTO rules. This means that some sectors would be exposed to high tariff levels under post-Brexit arrangements. Agriculture, textile, and footwear sectors are among the sectors affected most in the front line, and also around 30% of the products in the transport equipment manufacturing industries. However, the typical size of a firm differs quite markedly across sectors. And as it happens, the sectors most likely to face steeply higher tariff barriers contain a disproportionate number of micro and small traders. Therefore, we suspect that moving from the zero tariff regime in the EU to a most favored nation trade regime would mean that the strong push to micro and small exporters to divert towards alternative markets. And I will show in the next few slides that this is indeed the case. Now, the challenge of this analysis is to really separate the confounding factors that may affect the trade flows to EU versus non-EU markets during the same time. We adopted a difference in difference approach and used a large battery of robustness checks, reaching the following conclusions. Now, looking at all exporters, we derive the extent to which the relative growth in exports to EU to non-EU, controlling for things like the exchange rate volatility and exporters' characteristics, as well as the characteristics of the macro conditions and characteristics of the exported goods and exported destination. In this diagram, anywhere below zero, below the zero line, which means negative relative growth in exports to EU compared to the exports to non-EU. Then the longer the bars are below zero, the larger the extent to which the export diversion has happened from EU to elsewhere. Now, there's immediate evidence that the business's reaction towards business referendum announcement itself has been negative. Total negative in terms of moving more exports to non-EU markets relative to EU markets. Now, the total quarterly exports to EU decreased, while the total destined elsewhere has kept growing. The triggering of Article 50 at the end of the first quarter of 2017 created an even stronger trade diversion. Both overall number of products and new products exported show a clear redirection away from the EU. The similar trends are found for the total export value, the number of exports, exported goods, and the number of export destinations. And the same goes with the new products and new export markets. But this impact was not uniform across firms and products. On this slide, I would like to show you that micro and small traders diverted their export to a significantly greater extent than larger firms. Remember that any estimate below zero shows the trade diversion from EU to non-EU destinations. And you will see that bars are much longer for micro and small firms and medium firms compared to large firms. And this effect has been the same for number of the products, the export value, and number of the destinations. We attribute these patterns to the fact that smaller firms may have much less capacity to endure the potential increase in trade costs and risks of Brexit. In particular, the micro and small firms have mainly redirected their exports towards places like Commonwealth countries and BRICS countries. And then this may perhaps be because the historical linkages and also because emerging countries' economies might promise a greater growth potential. Looking into the market destinations, interestingly, we find that the divergence between intra and extra-EU exports growth is particularly pronounced with respect to more distant extra-EU countries. But among them, firms tend to opt for relatively richer extra-EU markets that are perceived as less risky and more profitable. So here on the diagram, the horizontal line referring to the level of the wealth measured by GDP per capita of the destinations of exports. So you will see that effect is much stronger for countries tend to be wealthier. So that was a very quick snapshot of the core finding of this piece of research. We've done a lot more analysis and robustness check, which are all explained and reported in our paper on our website. So please be free to check it out if you are interested. This analysis that is really based on 340,000 export transactions by 26,000 UK firms over a 5-year period really gives us a sense of the reactions of the UK exporters and indeed importers reacted towards the Brexit uncertainty. We've estimated that the smallest micro exporters have switched as much as 46% of their new export growth by value from EU to non-EU markets since the Brexit referendum in 2016, and that is, according to our calculation, worth about 10.45 billion a year. But whatever the decision logic used by the firms, this export redirection will be quite costly and risky to exporters. Transport costs are higher. There are new markets to understand, new trading relationships to establish and develop, a new, perhaps difficult currency and credit risks to deal with. In a somewhat longer term sense, this can mean negative impact on firms' productivity. Other research has demonstrated that exporting into sophisticated and competitive markets drive innovation, not just for large firms, but also for small and micro firms. The EU is one of the such sophisticated markets, whereas many of the markets identified in the trade redirection following the Brexit probably are not. Similar negative outcomes can be expected if firms, say, are dropped out of the advanced supply chain networks, linking them to the EU single market. To overcome such risks, focused policy supports could be handy for firms not large enough to have the sophisticated international marketing and trading capacity. The government and its trading promoting agencies need to provide information about the market destinations and provide guidance in access strategy for new trade destinations. They also need to ease exporting administrative processes and stimulate financial support, financial risk management, and educating in terms of the strategic marketing. Interestingly, these actions are those which were taken by countries like Japan and Korea in their successful export-led growth national strategy. Now we move on to COVID. Coronavirus has been a real shock. Thinking of the connection between the coronavirus shock and trade and globalization, it is really important to know that both its spread and its impact have to do with the prevailing globalization. Goods and capital and people are so closely connected today that really allow virus to travel fast and wide. The production and services are tightly networked in modern production. That really means a halted production in a small factory in the city of Wuhan might lead to low inventory, discontinued assembly, and lost profit in the UK. Just as the spread of the virus took very different shapes in different pace in different places, the impacts of the COVID-19 really differ considerably on different firms, industries, regions, and countries. And in turn, the responses of the firms, industries, region, and the national government really differ. That would lead to inevitably different outcomes and routes for recovery and their capability to deal with the future shocks. The crisis of COVID is like no other, according to IMF. In terms of its scale and spread, it is considered the worst recession in 100 years. Although the specific figures are still being regularly revised, we know that the most countries have experienced and will continue to experience a significant contraction in the economy, among which the UK is one of the worst affected, as we all know. By June this year, the GDP growth in 2020 was forecasted to be around 14% down year on year based on the double hit scenario, which is now a reality. In terms of the COVID and trade impact, what I'm presenting to you here is the OECD figures of the trade flow in terms of exports in goods. Down but not out is perhaps a general description of the general trend of international trade over COVID period. G20 international merchandise trade really collapsed in April 2020, but began to recover in May and June as the containment measures eased. So in this diagram, you can see some of the countries, and in a developed world, which more or less following the same trend, some countries might experience less contraction like Japan, but other than that, most of the countries following similar patterns. So by June, these trade figures have bounced back quite considerably. If you check the recent figures in August, you will see a slight dip, but not very deep. Indeed, as OECD forecasts, the UK 2020 annual growth in trade in goods may be between 0 to 20%, depending on the development of the COVID situation. In a double dip scenario, UK's trade growth has been forecasted about 20% less compared to 2019. Really, across the world, probably the only country which has come out of the COVID crisis quite well on trade figures is China. So by March, the trade figure, the export figure has been recovering very fast. And by June, the Chinese trade has recovered to its pre-COVID level. And just already see in July, the growth figures really has already grown year on year by 6%, with import growing about 1.6%. The pandemic crisis might have created the sense of a turning point of globalization. However, this is not really the case. If we put that into perspective of a long-term trend of trade and globalization, international production and in some cases hyper-globalization, leading to a very highly fragmented production across borders, saw about 2 decades of rapid growth, but followed by a decade of stagnation since the last great recession. The United Nations Conference of Trade and Development figure now depict a very clear figure. So we know that the trade value of intermediate goods has between 2000 and 2020 has reached $10 trillion, which gives you a sense of how fragmented production now has been reached. At the same time, the global value chain today are complex and extended production networks that are tightly connected firms, sectors, and countries. From this visualization using the World Input-Output Table data, you can see that much more is connected in 2014 compared to 2000. Now, why this development has taken place? The development of globalization is really driven at the beginning by the rationale and principle of business practices in the global value chain. In short, cost, efficiency, and proximity to customers. At the very beginning, when FDI started be quite prevailing and exports taking off quite dramatically, the cost minimization through controlling inventory levels, on time in full deliveries, shorter lead time has been the priority. And that explains the motivation of FDI and the trade. The length and the complexity of GVC, though, has increased as multinationals now expanded across borders in pursuit of the margin improvements. And during those times, there was less consideration being given on the transparency, the resilience of the supply chains, and social responsibility. And these priorities and motivations really have changed over time. The global value chains have been evolving. First of all, the motivations of multinationals have been evolving. From the very beginning, seeking low-cost production to later on much more complex investment seeking for a combination of advantages. In all except the most labor-intensive industries, companies started to base location decisions on other factors, including access to skills and talents, supply chain ecosystems, intellectual property protections, and building really with the host economies, infrastructure in intangible assets. Also, manufacturing productions provide services known as servitization has become increasingly more service intensive, and that is important to build their competitive advantages. Hence, proximity to customers become an important factor for location choices. At the same time, developing countries also moved up the value chains over time, with the most notably examples of Japan, Taiwan, Singapore, South Korea from the 60s, Mexico and China in the 70s and 80s. Over time, we also observe a trend of the regionalized and concentrated supply chain networks. And this is, of course, a big topic by itself. We cannot elaborate too much. But overall, what we see today is no longer a world system of production arrangements, as we saw a few decades ago, but instead a more regionalized, concentrated supply chain network. The long-haul trade between regions now took off in 90s and early 2000 as the global supply chains has really lengthened. But recently, the trade has become much more regionalized and much more concentrated, particularly within Europe and Asia Pacific. And this really has enabled companies to serve major markets quickly and responsively. We're going to leave the geopolitical factors aside, but just to say that the US-UK trade wars and the tendency to break up the hyper-globalized regions has been also important parameters to consider the long-run trend of trade. Now, after the breakout of COVID, there has been a lot of discussions of whether this is the end of globalization. Now, to some extent, COVID-19 really did not change anything fundamental. but really it acted as a catalyst for the long-term changes that has already undergone for years. It merely sped up the changes that were due to happen. Now, quite briefly, we move beyond COVID and Brexit and talk about trade opportunities and challenges. Now, looking beyond COVID and Brexit, no matter how Brexit is going to take shape, the UK businesses are facing new opportunities. Over the crisis period, I interact regularly with businesses. I can't tell you how impressed I've been to hear the tales of the businesses which adapt their new products and services very rapidly. And the new sectors, new markets can emerge very quickly with unpredictable technological changes. Now, there are new ways of doing business and new ways of engaging in trade with more advanced e-commerce technologies and blockchains. Optimistically, maybe the push of COVID-19 and Brexit will lead to new internationalization opportunities for businesses. With the changing conditions of the global trade environment, the new trade agreements that the UK will make with US and EU and other regulations, plus the UK will lead G7 and B7, potentially more influence in WTO, it is really worth reassessing which territories and line of products are where UK businesses in different sectors really possess the most advantages. And this is one of the themes of our research. Of course, there are challenges, and some challenges might be substantial. The full extent of the disruptions of COVID and Brexit is yet to manifest. There may be plenty of barriers of internationalization that is forthcoming, supply chain fragilities and tariff regime changes with EU and other countries, and non-tariff barriers to goods and services, especially services, and particular barriers faced by SMEs, which might be cognitive constraint, which might be information constraint, it might be gender issues, it might be human capital and skill shortages, and really the technological barriers such as e-commerce technology and skills. And really the efforts needs to be made to seek for solutions to these problems, and thinking of the positive roles that can be played by economic policy and trade policy at a high level, and really local and regional governance and business supports on one side, and the business support, the network supports between businesses on the other. And these understandings will certainly be hugely relevant for both business and policy to design appropriate supports. Now, finally, benefits. We don't quite understand thoroughly how firms learn from exporting, and how does that benefit of such engaging in exporting and learning outcome of exporting can spill to others. And this has to be one of the themes of the future research. And at the same time, very importantly, we really need to understand better the trade-offs between the efficiency and the distribution effect of gains from trade, between different players of trade that engaged by businesses. For example, between large and small companies, between goods and service providers, between multinational companies and domestically owned companies, and really in different places, and between trade and non-tradable sectors, and as well as those with varying degrees of diversity and inclusiveness. And these themes will help us to really sustain trade in a foreseeable future and a highly unequal world, and in a way that trade needs to build on the shared prosperity in order to be sustainable. And again, these themes are our regular pursuits of our research, and we do hope in the very near future we can share our findings and insights with you. Thank you very much for joining me today.